Hello everyone, and thank you for tuning into this update. I'm Joshua Dobi. Appreciate so much you giving me a few minutes of your time here as we get to the end of 2022, ready or not. I mean, it is the Christmas and New Year's season literally here upon us, and hard to believe that we're already at the end of this year, 2022, and 2023 just around the corner. But I appreciate so much that you take a few minutes here, and because I want to be respectful of your time, I'll hammer right into this quick update. I want to just touch base with you on a couple of different things which have continued to move forward here. You've heard me talk a lot about these items here over the last couple of updates, and specifically having to do with interest rates and inflation. We just got a couple of new numbers here in the last week or two with regards to inflation, looking like it's on a downward trend, but interest rates, at least insofar as cost of capital is concerned and the markets are concerned, continuing to increase, with the Federal Reserve increasing by another 50 basis points, or 0.5% here at their December meeting. Much more importantly, though, as far as what we're doing here and the kinds of things that we're watching, has to do with what the Federal Reserve indicated for the first quarter of 2023. At this point, and things can always change, this is a very fluid process, but at this point it looks like the Federal Reserve is going to increase interest rates another 2 more times here in the first quarter, which would be February and March, meaning there's no meeting in January, but there is a meeting in February and then in March. At this point, we anticipate that interest rates, the overnight lending rate rather, is going to increase by 25 basis points, or 0.25% at each of those 2 meetings, which would be another 50 basis points, or 0.5% over where we are today. At least that's what the Federal Reserve is indicating. So all of that being said, and that's some of the more technical stuff that we're watching here, what does that mean as far as the market is concerned? Well, we're pretty cautious right now, and I'll say it even more pragmatically. We expect to be, metaphorically, in a little bit of a washing machine kind of cycle here that we have been literally for the last 3 or 4 months or so, continuing into the first part of 2023. We don't expect that the market is really going to feel confident about moving forward until the Federal Reserve is at the end of their raising cycle and they get inflation to a point where they would like for it to be. Now, the Federal Reserve at this point has said that they would like for inflation to be in the 2, 3, 4% range. That's still a pretty far decline from where we are right now, our most recent numbers being in the 7% range. So we still have some road to go. But I would also offer up to you, at least from our perspective here, we still don't know the full effects of all of these interest rate hikes which have happened here over the last 9 months to this point. And it will take about a year, because of our economy size, looking at $27 trillion worth of GDP, roughly, or gross domestic product, a very large economy. It takes about a year after the end of a raising cycle, rather, for us to understand what that truly means as far as our economy is concerned. So we continue to be in a space of saying, yes, the markets are going to continue in this washing machine type of cycle where there are going to be big ups and big downs, but not a whole lot of movement, either positive or negative, from where we are currently. But then also looking at what the true effects are going to be from all of these interest rate hikes. Probably still a year out from where we sit right now. So it could very well be the holiday season of 2023 before we have a real handle on understanding what all of the economic impacts will be. And that also means that we expect, as you can probably ascertain from what I'm mentioning here, that we're going to continue to be pretty modest in our assumptions about what the markets, specifically the equity markets, are going to be producing here over the next several months, even as much as a year. I like to keep my expectations low. You know that. I think it just kind of keeps us sharp and on point with things, but we don't anticipate that the market's going to really feel confident enough to move forward until the Federal Reserve is done with the raising of interest rates in this cycle. So we're anticipating that will at least be Q2 of next year, and then that would mean that there's going to need to be some time for the market to get into a new pricing model with this interest rate environment and what exactly that means as far as equity prices are concerned. So I don't mean for that to look at the glass half empty. I still believe there's a lot of excellent possibility in this market, but I do want to set up your expectations a little bit in terms of time frame, that it looks like we still have some road ahead of us. We're not expecting any kind of parabolic move of appreciation anytime soon. I hope that I'm horrendously wrong, and we do see that, but it doesn't look like that at this point. So I wanted just to give you that update as we're approaching the year end here, and obviously equity markets as measured by our most popular indices, not what we would have desired for this year. But that's coming off of a couple of years where we were way above the median as far as overall returns are concerned, especially, again, as measured by our most popular indices. So there is a little bit of a reversion to the mean that we see happening here. It just happens to be that it's in a more inflationary and higher interest rate cycle. But there also, from a very technical standpoint, at some point has to be a reversion to the mean because that's what makes the mean. So we've seen that this year, and again, we're looking forward to 2023, but doing so with muted expectations as we kind of get through this final act of the movement of the Federal Reserve, and allowing the market then to push forward at that time as they feel more comfortable with pricing models at these new interest rate levels. So again, I just wanted to share that with you as we get towards the end of the year. If at any time you'd like to take a look at your particular portfolio, talk about strategy, talk about maybe are there things that we need to tweak or adjust, or are you thinking about things differently? Perhaps you've had life changes that would cause you to come at this thought process differently when we're looking at portfolio structure and management. I always love to hear from you. Always feel free to reach out, email, phone, set up a time on video as you're doing here to be able to talk through the kinds of things that are on your plate. I'm always happy to do that, and I always enjoy hearing from you. Well, friends, again, in the interest of time here, and because it is indeed the Christmas and Hanukkah and New Year's season, I'm going to cut this update short. Please receive a word of thanks from us here. We are so very thankful for each and every one of you. The ways that you entrust us and the ways that you do, we take that very, very seriously. And we thank you for that, and we're humbled by it, and we work hard every day here to ensure that we continue to be deserving of that trust. So thank you so much for that. Please also receive the merriest of Christmas wishes, happiest of Hanukkah wishes, and the happiest of New Year wishes as we move through this enjoyable holiday season time. As you know, folks, always feel free to reach out to us. And until the next time, I'll look forward to chatting with you soon.